Institute. So without further ado, I would ask Razia to go first. You have 10 minutes, and then we'll be followed by partners.
Thank you, Your Excellency. I do hope I can be heard suffering from a cold, but I haven't travelled to anywhere exotic very recently, rest assured, for people seated around me. The global recession and Africa, what I thought I would focus on is maybe the way this was all seen from the investor perspective. The way investors first reacted with the onset of the financial crisis, what people thought we would be seeing in Africa, and how we've actually seen things develop, for giving us a greater indication of the outlook, where we head to next. It has to be said that at the start of this crisis, there was a great deal of optimism. This was really seen as a financial markets, a financial sector crisis, and everyone knew that sub-Saharan Africa as a region had very few linkages with the rest of the world in terms of financial linkages, and therefore was probably, from that perspective at least, seen as the most likely to be immune to the crisis. What few people at that point were seeing was the vulnerability, the long-standing vulnerability of African economies, the extent to which they had become more interlinked with the global economy through the recent boom, not just in commodity prices, but also in portfolio flows to the region, and how the absence of that liquidity, the portfolio flows into Africa, but also the longer-term FDI flows, a lot of the liquidity that African economies had become very used to, the absence of that liquidity meant that it was all change in terms of the growth picture. Just to recap, what was it that investors were looking at in the context of sub-Saharan Africa? Few observers would realize that, in a sense, the portfolio flows, the appetite for African assets that we've seen recently, have a lot of similarities with the origins of the subprime crisis. The sort of global conditions that gave rise to that investor enthusiasm for African assets were very similar. We had the large savings imbalance, so current account surpluses being built up in China, in the Middle East, a lot of that being recycled into Western markets, that helping to keep interest rates low, as we saw a lot of those flows going into US Treasuries. And of course, the persistence of those low interest rates even into the economic boom, giving rise to levels of risk appetite that were almost unprecedented in recent history. In the West, we know that this largely led to a lot of financial innovation, the rise of the originate and distribute model, the so-called slicing and dicing of risk, that was to lead to all of these problems. But in the context of Africa, this also meant that investors were perhaps looking for greater risks, were becoming more comfortable with risk, and if you like, were going out further along the so-called risk curve. During this time, we started to see very favorable rates of global growth, and that, of course, was good for commodity prices. But more than that, we saw unprecedented flows, capital flows, into emerging markets. The large, more traditional established emerging markets became very much commoditized in terms of the kind of return that they were able to offer. So you started seeing investors looking for different ways to drive returns. Part of that was the increasing use of leverage. Another part of it was to go out to the so-called frontier markets. African economies, which traditionally hadn't been large recipients of portfolio inflows, became very interlinked to the global economy, in the sense that investors who previously hadn't been that active in the frontier African space became that much more interested in the continent. And of course, as tends to be the case whenever you see global growth being favorable, whenever investors are complacent about risk, the long-standing political issues in the continent were seen to matter less. The only things that really mattered was the immune to the emerging market sell-offs that we saw in May-June 2006 or in January 2007. Those were short, sharp episodes of volatility. A lot of investors still believed that this degree of non-correlation between African frontier markets and the rest of the world would remain in place. All of that, of course, was proved to be untrue. with what happened in the wake of the Lehman's bankruptcy last year. We saw huge investor withdrawal from all emerging markets. In the liquid emerging markets, this tended to matter less. They have been more open to portfolio flows, and so that kind of volatility was not a new thing. Investors had pretty much thought of themselves as a different class, the type of investor who typically got involved in sub-Saharan African frontier markets was the kind of investor who, in theory, should have been there for the longer term. They knew that these were small, illiquid markets. If they were to try to sell out of these markets, liquidating their positions, they would do that at the risk of moving price against themselves. Also, the financial sector and the real economy risks as regarded Africa were supposed to have been different. Yes, Africa had benefited from the recent commodity boom, but the real story behind the region's turnaround was what had happened to domestic demand. These were African economies with vast potential, for the first time in many decades, growing at the kind of growth rate that Africa should have been achieving all along. Investors were very complacent about the risks. Also, observers didn't pay attention to the fact that when you have the same investor class invested across the different markets, it doesn't matter that historically African markets had been less susceptible to contagion. When you do have the same investor class becoming more involved in these markets, and if you like, African economies had become more mainstream in that sense, then that degree of non-correlation was bound to break down. So although it didn't get a great deal of attention internationally, that's precisely what happened in the African context. The problem is that bad news didn't just end with the withdrawal of portfolio investment. For a long time, investors had reassured themselves, saying that at precisely the time that they became more interested in African markets, debt markets primarily, this coincided with a period of fiscal consolidation in Africa, governments running smaller deficits, there wasn't that much to invest in anyway. The common complaint that was seen pre-crisis was that investors had a lot more money that they wanted to put into Africa, but securitization was just not happening fast enough for that to happen. In a sense, perhaps African economies were fortunate in that the debt markets hadn't been large enough to see a more marked effect with the withdrawal of that portfolio investor interest. At the start of this year, we started to see tentative signs of risk appetite returning. There was a feeling that in terms of the real economy effect, that we were over the worst, that green shoots of recovery started to be seen elsewhere, people focusing on the export performance of Asian markets, over the worst, a lot of the economic indicators out of the developed world suggesting that whereas we weren't going to be seeing a more optimistic scenario anytime soon, a much more positive scenario rather, at least we weren't seeing the worst of the crisis, which seems to have passed with the fourth quarter of last year. The problem is that investors are still pretty much taking a hands-off attitude to anything that poses real risks. There's a great deal of uncertainty about how African economies are now going to get through this crisis. It isn't just the matter of portfolio inflows that have been withdrawn, that have turned around. Even though there is a large amount of cash on the sidelines, African economies are still seen to be perhaps too much of a risk. Investors are not looking for those higher yielding, higher risk opportunities. They're looking for potential safe havens. In this environment, African economies may be the last to benefit from what's been going on globally, the resurgence in risk appetite. The real risks have to do with the real economy. That is, FDI has fallen. Traditionally, that has been very much correlated with the resources sector. Commodity prices have corrected, and it will take some time before even the revival of commodity prices, the turnaround that we've seen, makes a meaningful difference in terms of FDI. Other flows, although remittances have largely held up, if you look at unemployment rates in the source countries of these remittances, a big question mark about how long this will continue to be the case. What all of this means is that the liquidity that eased a lot of the vulnerability, the long-standing vulnerabilities that perhaps had always been there, that investors didn't pay sufficient attention to, that has been withdrawn, and what emerges is a much more difficult picture. most African countries with shallow capital markets, unable to raise the financing that they might need to provide a fiscal boost to their economies, are caught between a rock and a hard place. We see countries increasingly reliant on very short-term financing of the deficit. The gains of recent years in terms of having been able to bring inflation under control, the macroeconomic stability, all of that is increasingly called into question as countries grapple with how to deal with this very difficult economic backdrop. We could probably go on at length about possible solutions to the crisis, but I'm told we're already out of time, so perhaps we'll leave that to the Q&A session.
Thank you, Razia, for that concise presentation.